Right. Thanks so much for tuning in to this conversation with Steve Brice. He's CIO of Standard Chartered Wealth Management. Joins us from Singapore to talk about all that's happening around the world. Remember, it was also a weekend when the Oracle of Omaha came in and talked about his stance, which arguably seemed a bit cautious, more so on the banks. I'm not saying he sounded cautious explicitly, but the large swaths of cash that he's sitting on probably likely show his stance. Though I doubt that Warren Buffett likes to time the markets. But let's get in Steve Brice, who, as I gathered, while I was talking to him just before this conversation started, is equally cautious. Steve, great having you. Thanks for joining in. Good morning to you.
Happy to be here.
How do you look at the current landscape, Steve? Buffett and Munger sounded, or at least my interpretation was that they sounded a bit cautious.
Yeah, I guess we're in a similar situation. So the way that we look at the current environment is we're expecting a recession to come to pass. We don't agree with the Fed chairman who is playing down the risks of a recession. I think if they were to pull off a soft landing, it would be almost incredible. Probably the best achievement of any central banker over the course of certainly my career. We have a lot of headwinds out there. Obviously, the labour market is still strong, but even there, the forward-looking indicators are starting to show some signs of weakness. So, from our perspective, that recession is still to come, and that means that we're a bit defensive when it comes to playing equity markets at the moment.
Steve, not too many people are clear of the impact of the large debt numbers that the US is running. Janet Yellen's comments supposedly about how they might not be able to meet the payments, what have you, or the debt numbers that they are as yet. Now, have you thought through what, I'm sure you have, but what are your thoughts on what this means, one, from a US market perspective, if anything, and two, the collateral effect that it could have on other markets?
Yeah, so clearly we're heading towards the debt ceiling debate. Well, I mean, we're in the middle of the debt ceiling debate. There's a lot of this, uncomfort or discomfort as to when exactly the government will run out of money. Obviously, Yellen sort of saying it could come as early as June 1st, which is 2 months or more earlier than previously anticipated due to disappointing tax collection season so far. So yeah, I mean, if we look at the way this normally plays out, I mean, usually you don't get a default. We do think there's a non-negligible risk that we could see a default this time, just due to how far apart the politicians are on either side of the aisle in the States. Not a central scenario, obviously, but it is a risk. And in that environment, it's just another thing to throw into the mix, as well as obviously the regional banks issue in the States, to be a bit cautious on risk at the moment. Usually during the standoff, we see equity markets suffer, we see gold rally, we see safe haven currencies doing well. And that's sort of pretty much how we're set up at the moment. We think that this could be quite a bit of a challenging environment, obviously in a seasonal challenging stage as well. And the sell in May is obviously something that people are always thinking about, at least at the back of their mind. So I think there's a lot of things that could still go wrong for the US economy, and again, that just backs up our defensive stance.
In which case, Steve, if you are pointing towards an impending recessionary period in the US, it would mean weakness for most exporting countries, because US is still the largest consumer, right? And therefore, what is the collateral damage of what you just said on other markets and the emerging market pack in particular, or the Asian market pack in particular?
Yeah, clearly, as you mentioned, the US is still a very major economy, so any headwinds from an economic perspective there would be felt across the world. There are some mitigants around this, and we've sort of been highlighting that this is almost like a mini 2008, 2009, where the US obviously is hit by its own shock domestically. But then China is, in that situation, they're stimulating again now, but really it's a reopening trade. So the Chinese economy is on a very, very different profile. So that will soften the blow to some degree. But yes, if the US goes into recession, then clearly that's going to have a massive impact on global trade and on risk appetite across the world. And so that's a concern for us, and I think for most market participants.
The optimists around, say, for example, India, Steve, I'm using India as an example, talk about how the bond yields having fallen to 7%, though People are saying that with the large issuances, even that's a question, and I'll come to that in a bit. But just the broader concoction of lower yields, lower crude prices, stable earnings growth, right, and valuations which are above mean, but not exorbitantly above mean, so to say. So the bulls believe that this is a good place to be in per se. However, the skeptics say that just the fact that earnings growth might be a question mark going ahead and the valuations are expensive, if the US comes off, then everything should come off, which would mean that India will see a corrective move too. Any thoughts on EMs, particularly as a result of this, and India in particular?
Yeah, so from our perspective, we still favor China over India, but I think what we are seeing is a very significant pivot in terms of valuations. So valuations in India have come down quite markedly. If we did see a global slowdown, then I think India is probably more protected than many emerging markets in that environment, especially if oil prices have come down as a result. So from that perspective, we have a neutral weighting to India within an overweight allocation to Asia, Japan equities more generally. But obviously, we're always kicking the tires on that. That's worked out reasonably well for us so far, as did our overweight last year to India. So we're always looking at things to see whether now is the right time to be upgrading India back to an overweight or not.
Yeah, I was wondering because, I mean, when I look at the Chinese move, right, the economic cues are sputtering, if you will. Yes, consumption-driven, spending-driven pullback, but not much happening on the economy. Or maybe you believe it will happen in the second half, part one of my question. And part two of my question, on a relative basis, FIs have sold out India so much that this last 10 days buying of nearly 12,000 crore rupees, or about $1.5 billion, doesn't surprise too many people, and people believe that the second half will be punctuated by FIs returning to India. So in light of that, how is the relative scene of China versus India?
Yeah, so obviously we do see the economy is accelerating as we go through this year, right? So from that perspective, that's still coming through. But it's a really interesting point on the FII interest. I mean, actually, both China and India have seen a lot of people leaving those markets. India, actually, even through the rally last year, FII interest was relatively low. So from that perspective, when people do get a little bit more optimistic on the environment, you could see that coming back. But I guess the challenge is if developed market equities are suffering, and are clear not yet, but if they start to suffer significantly, can other emerging markets really start to go against that tide? We think in China they possibly can. India may be a bit more defensive, but it will be the proof of the pudding is in the tasting, of course. I think that's the challenge to getting FIIs interested again. Is they want a bullish outlook overall, not just a defensive place to be.
In which case, the final question, Steve. Now, I'm presuming we'll get a chance to talk to you only after 3-4 months. So I'm asking you a quarter out scenario right now. That is, and I know you invest for the long term. I'm just trying to think as to how you're thinking about the near term, since there are so many moving pieces. You already told us that you are cautious. My question is, if you're kind of figuring out which quadrant to be in and which quadrant to stay away from for sure, between commodities, say debt, or global equities, or otherwise, if you're cautious on global equities, are you constructive on something else?
So I guess the two places that we like, and a third I'll add in terms of just, I think it's a good place to have an allocation as well. So the two areas that we like are high quality investment grade bonds in the developed world, also in Asia as well. So we believe that that's a good defensive place. Obviously, yields are much higher than they have been in the recent past. So just hunkering down in that space is pretty positive. We're bullish on gold. We think we're threatening to break out to new levels in gold, and debt ceiling talks usually when they kick off in a significant way, gold usually does very well in that environment. And also just having some powder dry in cash, I think makes sense in this environment. We are bearish on equities, but we would be looking, once the Fed pivots to focusing on growth rather than fighting inflation, then that's probably a time to start deploying some of that money back into equities. I think we're still some way from that point, but having some powder dry on the sidelines probably makes sense in this environment.
Steve, I'm sorry. I know I said that was the last question, but I'm gonna ask you one more, if you don't mind. Extend this conversation just a minute more, and maybe a bit of a repeat because it's such an overwhelming point which not many people understand. Just trying to understand if the Fed pivot is some time away, uh, but the equity markets currently seem to be bullish. Would it be the US debt ceiling issue that brings about the trigger for the correction, if you will? Or could it be something else? Is that such a big deal, or could it be something else?
So it obviously could be the debt ceiling. I mean, if the politicians double down on this impasse, then a debt default would obviously be very traumatic, I think, for all risk assets around the world, particularly in the US. So that could be, but then it could just be we see for instance in data tonight we could see a very, very significant tightening in lending standards at the banks that really makes people reevaluate the timing and magnitude of a recession. We don't think this is just going to be a run-of-the-mill recession. We think it's going to be a little bit more severe, not financial crisis in nature, but something a little bit more severe. And if the credit downturn is more severe, that could lead people to reprice recession risks and magnitude, and that could lead to that last leg down in equities before we see a bottom.
Steve, lovely talking to you as always. Thank you so much for spending the time, and have a great week ahead.
You too.
All right, viewers, and that's the conversation with Steve Brice of Standard Chartered Wealth Management. Thanks so much for tuning in.